Welcome back to Morning Movers. I'm Diane King Hall coming to you live from the floor of the New York Stock Exchange. Joining us now, we've got Bill Baruch, President of Blue Line Futures. Bill, it's so good to see you this morning. Why don't we start out with the price action that we're seeing in crude oil this week? Yesterday, we saw some pressure. Obviously, that made sense off the back of the news from OPEC Plus about plans to boost production. We're seeing a little bit of a recovery here when I look at WTI right now, which is just above $58 a barrel. Is this really just a buy the dip crowd?
I mean, we bounced off of the level that was post April 2nd, and so obviously some great support down there. We back it out, though. We do see the commercials, the producers have been leaning in long over the past few months, and that's a little bit of a signal for us. Now, they did talk about bringing production back on. They're going to do that. And if you look at it, from the math here, it is a oversupplied market, but if you really get granular, you back out Iranian barrels, you lower U.S. production a bit, you back out some of the Venezuelan barrels. The picture looks a little different here, and higher U.S. gasoline demand. Maybe there's some tensions in the Middle East that spark up. Maybe there's some tensions between Russia and Ukraine, or Russia sanctions that come back. There could be a really great case here to see oil back above $60. The market on Sunday night, it opened sharply lower. Felt like it really kind of flushed a lot of the negativity out there. And the other end of it, you need buyers. So obviously, I said commercials, producers, they've been buying. The other part of it too is managed money. They're not very long. They've been getting a little longer, but there's room for them to step in and be buyers here.
And then speaking of buyers, we're seeing gold creep higher once again. When you think about the commodity space, whether we're talking about gold, oil, or copper, where is the most compelling case right now and why?
Well, gold has obviously been the winner, and it's going to. Yeah. There's something here to think that gold won't continue the path that it has been on. Look at the overall with U.S. This is a story we've seen over the last couple of years where foreign buyers, now they're sort of lingering of U.S. debt. And where's that money going? It's been going into gold. Central banks are big buyers of gold. China came back from holiday, big move in gold over the last 24 hours, really. Now, with that said, typically gold can be the leader. And then we get silver and copper, and then even platinum and palladium should be able to follow that. Though we remain long gold, the volatility has been enormous. So we're sizing our positions in gold at Blue Creek Capital with the CTA that we have in the right manner to withstand this volatility. We are a little heavier in silver and leaning in a bit of copper strategically here because we think there's some catch up for both of those to see. Now, with all that said, it is a little bit of a seasonally lull period for gold. So we're taking that in mind. But the seasonals haven't worked very well since the Trump administration won office in November.
Mm-hmm. And in terms of positioning, what are the technicals, or what is the positioning in terms of futures telling you about sentiment under the hood, Bill?
And the positioning in the metals, there's continuing to expand. I think right here. But historically, we're really not at overbought levels. We haven't really seen. We've seen continued flows into ETFs, but I think there's a lot of room here to continue to expand. It's really a different dynamic than what we've seen historically with the central bank buying, and then obviously a lot of retail has followed. Now, if we start to see good news on trade, I don't really see the central banks being the ones that are selling. I think this is really a tectonic shift in their balance sheet. But we would see a shakeout in retail, and so that's one of the reasons why we're sizing our positions for this volatility. We're using put protection to protect our downside. Although we remain in a bull market, we've called this a historical trend. But I wouldn't be surprised to wake up any day as we did last week and see gold down $100. You got to be able to manage your risk in this environment.
Okay. And I know you track volatility closely. So we've got a VIX under 25 right now. So what's your big picture take on where we're headed in this short term when it comes to volatility?
As volatility comes down, it does open the door for positioning in equity markets. Hedge fund desks that have to take down positioning as volatility gets above 20 and above 30, and as we've seen in recent weeks. Now they're able to reposition, and that's been a tailwind. I think that was part of a tailwind over the 9-day win streak. The White House also softened their tone on trade. Earnings have been better than forecast, although the quarter 2 guidance has come down a bit. In fact, quarter 2 guidance has come down more sharply than it has in the first month of a quarter in recent over the past 5 years. So maybe it's come down a little too much. We remain upbeat on the market, but it's not surprised to see a bit of a pullback as the VIX trekked back towards that 20 level, and the S&P did get back to that April 2nd gap. A ton of resistance up there. We're looking at the Fed meeting come Wednesday and tomorrow, and more news on semiconductors and tariffs potentially later this week.
Bill, let me ask you, do you see any disconnect between, say, the macro reality and how the market may be pricing things, especially given that we've seen some turbulence? We don't have a tariff deal yet. Hopefully we get one sooner rather than later. Is there any disconnect in your mind?
I think the markets act extremely efficiently. They discount moves very quickly. Heck, I was very nervous. Looking at how I had to position in the aftermath of April 2nd and even before that, some of the selling sort of unhinged and how best to manage risk. But that's really the toughest time to kind of work through. A lot of the times, and that's the market taking down the exposure. There's hedge fund desks. There's outright selling. But that's when that worst is in. Typically, the market can work off of that. This is not 2022. 2022, the Federal Reserve was out there and said they were going to continue to hike rates and drive pain. Now, yes, the White House is really out there on their tariff narrative, but I think with that said, some of the worst case scenarios have been quickly priced in when you've had this massive move lower. So I think right now I'm leaning towards comparing this to 2019 more than any other scenario, where the market really rallied out of December very quickly into January of 2019, and it was off to the races. Now there was some consolidations and pullbacks around that 4th and 5th week and 6th week. Around that time, this is where we consolidate. This is sort of that pivotal inflection point. Can this be a 2019 moment and we break out above 5750 in the S&P? I'm not discounting that. I think that is a real possibility in the next couple of weeks.
All right, Bill, thank you. That's Bill Baruch, President, Blue Line Futures. Appreciate perspective as usual.